Morning, market chameleons, and soon to appear Dmitry Pargamonic. How you doing, Dima?
Hey, well, how's it going?
Great, great. Let's start right with the disclaimer.
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance.
Excellent, excellent. What are you seeing this morning, buddy?
Okay. So let me grab control of this screen. I think we'll take a look at stocks moving into pre-market hours. We had some stocks reporting earnings. We got earnings coming up, so I think we'll just focus on that. If there are any questions along the way, let me know, Will. I'm going to try to get to those questions and answer as many as I can before the end of the show.
Sounds good.
All right, so this is the pre-market report. Stocks moving, pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to first take a look at what's going on in stocks with higher market caps, see what's going on there. So I'm using this filter, market cap, 20 billion market cap or higher. So I see 5 made the percentage gainers list. There are 25 currently on a percentage decliners list. So from that perspective, that looks like it favors the bears more at the open. The top of the list, Netflix right now. So they reported earnings yesterday, and I believe that they just said that their growth is slowing, right, with the subscribers. So they're down 8.3%. So let's take a look at Netflix closer, because that's a big one.
Well, a lot of competition has entered that market, right?
A lot of competition. I think what Disney is in that streaming market, and I believe that they've already, I don't know, they're getting up there, close to like Netflix, maybe 100 million subscribers. Then got like what Hulu. I think even Google's getting into it through YouTube. I don't know if they're creating their own content, but I think you can subscribe and get like cable now through YouTube.
Yeah.
So that's pretty interesting. Amazon, right? Amazon Prime. Do you have that?
I do. We do tend to use Netflix more. I don't know why we have Amazon Prime, mostly for the boxes, I think, that show up at our door.
Right, but that's already included, right?
Yeah.
So you get that service as well. And maybe look at what are they? Some of them are like $5 a month. Some of them are like under $10 a month. So it's possible that you have more than one service, right? I mean, what's
Well, we
Netflix?
definitely do, because we have the Disney service too.
Okay, yeah. So they might you might be they might not actually take things away from each other, because they also have their own content. But let's take a look at Netflix right now. They're down 8.4% in the pre-market hours. They closed at $549 yesterday, trading at 503.34 in the pre-market hours. Here's the pre-market VWAP, 502.35. That's the volume weighted average price. So we're a little bit above that right now. This is the range in the pre-market hours, 498.35, 507.85. So we're kind of in the middle of there. Since it's earnings, I'm going to take a look at historical earnings behavior. So I'm going to come down to here, earnings stock pattern, and let's just take a look what it did historically after reporting earnings. So we could see heading into earnings starting 2 weeks before, all the way up to a day before, it looks like it tended to gain, especially like if you're starting 2 weeks out, a little bit more frequently than losing. After reporting earnings, it looks like historically it gapped down more often than up. 64% of the time it was lower, 36% higher, for an average loss of 0.7%. After the opening, from the open to the high of the day, average move was up 2.4%. From the open to the low of the day, average move was down 3.1%. So at least from that perspective, it looks like more biased towards this downside. The magnitude of the down moves exceeded on average the magnitude of the up moves. From the open to the close of the day, looks like it drifted down more often than up. 73% of the time closed lower from the openings, 27% higher for an average loss of 0.6%. So here it looks like just generally weak after reporting earnings. Looks like on average for the day of reporting earnings, 73% of the time it was lower, 27% higher for total average loss of 1.5%. If we look at the magnitude of the moves at the open, on average, this is taking all these opening gaps, converting them to positive, and taking the average, because if you're looking from a perspective of options, we're looking at the volatility, what is the magnitude of the move. So on average, it moved up or down 6.1%. Let's take with a high of 13.4%, which was down here on July 16, 2018, down 13.4% at the open. Let me just compare it right now, 8.4%. So above that average, right, but within the range. And you can see here after earnings, it just tended to be weak. So stronger coming into earnings, weaker coming out, and weak the day of. So that's from a historical perspective, price return distribution after reporting earnings. Let's take a look. I'm going to come, let's just go to Netflix for now. And we could take a look at its earnings report. So here I'm on the earnings. Let's just see how they actually did. So we see here, this is the earnings, April 20th. Looks like they beat, right? Earnings per share, that's a beat. Revenue, that's a beat. So that's comparing consensus estimates, 296 versus they reported 375, so they beat by 79 cents. They revenue looks like 7.1 billion estimate versus 7.2 actual. They beat by 33 million on revenue, but the stock's down 8.7%. And that's one thing we try to kind of point out, that the stock, right, it's not necessarily if they beat or missed estimates, analyst estimates, it's what the estimates were of the actual stock traders, like what were stakeholders pricing in. And the other thing that's important is, what does the company say about the future outlook of their business? So I kind of try, to point that out, as we go along, because you're going to see this a lot. You could be on both top line numbers, right, and still be down 8.7%. Last quarter, they missed. Earnings per share up 16.9%. Okay, so always keep that in mind heading into earnings. It's not the consensus estimate. It's really, what are the traders, the people who are holding the stock, what are they, anticipating, and what does the company say going forward? That's really the important piece. All right. So, and obviously Netflix did say that their subscription growth is slowing down, right? So that's the reaction to that stock. Let me just see, go and post earnings drift. So here we see that Netflix actually, I'm going to come down here.
It's interesting because you wonder if that's a start of a paradigm shift. Like if they've been relying on constant subscriber growth to grow, and now they're not seeing that, and they have way more competition than they did.
Yeah, they exactly. They have more competition. So look, they're not that many ways, right? If so far on the current model, either they're gaining more customers or they're going to increase prices, until they come up with other, other types of products or services that they could sell to their current customers that would add to revenue. But I think their current model is either they're adding customers, expanding that way, or they're raising their fees. And what are we up to now? Like $17 a month in Netflix. And with competition, they might start seeing, some pressure towards the downside potentially, or it'll be harder to keep increasing fees. You would think, right?
Yeah, no, I mean, there's a whole discussion on the chat right now about people who've given up their cable box, basically have disconnected. And Mike from Naples, our mayor from Naples, was saying that he, Roku and YouTube TV are his two go-to products, but he's basically eliminated the cable box. So
yeah, no, for sure. I hear that all the time, and because you can now get it all through the internet, stream all those channels. And I'll tell you, Amazon, I have Amazon Prime, and I go in there and I watch some interesting documentaries I like on Amazon Prime. So they're actually even adding sports, I believe, in Amazon Prime. Now they're showing like NFL football games, so they're already going into those, into sports. I think they're adding like news channels, so they're becoming almost like slowly a replacement for cable as well. Or at least those traditional channels we see on cable TV. So let's just see how this stock.
Hey, D, your sound has gone underwater. You're gonna have to log out and pop back in.
All right. It's not good. Better. I'm gonna try that. No. All right. Let me pop out now. Pop back in.
All right. Well, Dimitri gets out from under the bathwater. Again, thanks everyone for joining us on the morning pre-market show. For those who aren't in the chat and aren't regulars and don't know, there is a great Discord group that exists out there that was created by Chameleons. If you want a link to join the Discord group, just email me at williammcbride@gmail.com. I know yesterday someone at the end was asking for it. I'll put it in the chat right now. Sounds like Dima just came back in there. Yeah.
Yep. You hear me?
Good. Perfect.
Okay. Let me just pop back in here. Tell me if you could see my screen again. Well,
looks good.
Okay. Let me take a look at, historically, how we're going to just compare historical moves in Amazon. And I think one thing maybe what we'll take a look at is I had questions about diagonals and calendar spreads. So I'm going to take a look at that, and maybe what we'll do is go to the options chain and just set it up to see what that setup looks like prior to earnings. Then we'll estimate like what it would look like today after reporting earnings. But I think that, that would be interesting because we haven't set that up that many times and shown that as an example. So we see here's Netflix historically, and what these bars are the stock's estimated move prior to earnings. So this was looking at, we're seeing here it starts at 0. And if you're buying a straddle, you're buying a call, you're buying a put, you're paying premium, and you need that stock to move either up or down by magnitude enough to cover the cost of that premium. So, if you're buying 5% worth of premium at the money, the stock has to move more than 5% for that straddle to be profitable. If you're selling it, the stock has to move less. And that's what these bars are showing. The actual move, it will be in a green bar when it's up, in a red bar when it's down. So here we see prior move, January 19th, stock reported earnings. Netflix reported earnings after market closed. The next day, stock was up 16.9% for the day. The straddle was implied a move of 6.4% the day prior to the move. So you could see that blew right through that straddle. This is where we are right now. Yesterday, the Netflix reported earnings in the morning, right? So we haven't opened yet. The day is not over. Right now, if we opened at this price, the stock would be down 8.7% from yesterday's close. Straddle was implied a move of 6.5% in either direction. So if we open up here, you sold that straddle, you'd have to buy back higher. If you bought that straddle, at the open, most likely you could sell that for a profit. Obviously, depending on how wide the markets are, so you got to pay attention to that. And historically, we see that the options overestimated the move 69% of the time. In Netflix, on average, the options were predicted a move of 8.4% in either direction before the market opened. I mean, sorry, the day before earnings. On average, the realized moves 6.4%, so you see 2% differential. And here we see that I'm just hovering over here and I'm just noticing that on average, it predicted 8.4%. But if we looked at yesterday's, that's below what it usually is priced in, right? So the straddle yesterday was only pricing in a 6.5% move. Okay, so yesterday straddle was pricing in a 6.5% move. Usually straddle on average priced in an 8.4% move. And we could see here that 6.5% very close to historical actual realized moves. So there wasn't that much in that straddle yesterday to begin with, right? Not if we compare it to historical levels. All right, is that hopefully making sense to everybody?
Let us know if that's not making sense. No questions yet, so I think it is, D.
Okay. So the other component in earnings is we know that two things usually happen, on earnings. There's going to be a move. So stocks reports earnings. That's when new information is released. Traders take that new information, input it into their models and reprice the stock. So we have a big move there, and that impacts the option prices, obviously. And we also know that implied volatility is up, and that implied volatility after the news comes out will come back in, right? So on average, how much does implied volatility come in is what we want to see. And when we look at implied volatility, the further you go out in time, the more there's more vega in the options. In other words, very short-term options, the most of that is pricing in the move, right? You don't have a lot of time decay, time to expiration. So most of it in a front month, that's gamma. You're looking at the magnitude of the move. As you go out further in time, you also have higher vega risks. So when we look at the implied volatility here, I'm going to reference here options with 30 days to maturity. Okay, so not the very near term, but 30-day constant maturity options. And we see here that on average, options with 30-day to maturity decline day after reporting earnings, decline by 30%. Implied volatility down almost 29%. Day before earnings, the average implied volatility 51.6. Day after earnings, average implied volatility 37.5. 5 days later, actually ticked up a little bit, 38. So how does this compare to historical? So we know the straddle was already priced much cheaper, almost by 2% than historically. We also see yesterday, this is the 30-day at IV, 37.5 compared to historical average 51.6. So we see that it's actually implied volatility was already subdued. So it wasn't that high to begin with, just like the straddle wasn't pricing that much. Neither was the implied volatility going out. As a matter of fact, like if we just compare where did the implied volatility end up being day after earnings? That's where it was yesterday, right? 37.5. Everybody see that? Hopefully.
It looks good. No
questions?
Yep, no questions.
Okay. I'm going to just kind of scroll down here and take a look. These are the historical implied volatilities heading into earnings. Okay, so we see average implied volatility 51.6 day before earnings, a high of 74 in the last 12 quarters. These are all the last 12 quarters, low of 37.5. So we were at the low yesterday, 37.5 compared to historicals. Day of earnings, so this is the close of the day after reporting earnings. So average IV 37.5, high 52.6, low of 28.7. So where is that 28.7 over here? Okay. So that's just really quickly reference numbers. And we see here that even at 37, doesn't really decline that much heading out. So just keep those reference numbers in mind while we come back to the options chain. All right, so 30% on average decline after reporting earnings, but the IV is really right where, on that low end where we usually are after reporting earnings. I'm going to take a look at these strategies here, and let's take a look. We have a calendar call spread, calendar put spread. Over here, we have a diagonal call spread, which tended to be a loser, and a diagonal put spread. So this one looks to me like this would have hit today. Most likely would hit today because it's when we do a diagonal, it's kind of like a put spread, but with different expiration months. So you're looking at different strikes, different expiration months. So I'm going to just set this up just to show you what it looks like, all right, heading into earnings, because we're still at yesterday's closing prices. We haven't opened yet. So how would it look like yesterday setting this up heading into earnings?
Hey, D, we did have a question that just popped up about volatility crush.
Yeah.
Robert is asking, is there anything that shows the volatility crush on different time horizons other than 30 days? For instance, I mean, I guess he wants to put in his own days, right? But he's asking, for instance, 7 or 14.
On some of the stocks, we're starting to generate that based, and what we do is we put it right on the options chain. So basically, I'll show you from the options chain. Okay. So there is for kind of even for each strike and days to expiration. So this is a general look, but you're talking about more specific look, you'd have to go to the options chain. So I'll try to show that as well. So cool. The answer is yes, but in a different spot. So let's take a look at this, a diagonal put spread. How that would have looked setting it up yesterday from the options chain, where the prices were, and where we anticipate. We don't know yet where everything is going to open up, right, until it opens up, but where we would anticipate based on, we kind of know where the stock is heading, right? And we're going to have to guess where the implied volatilities might be. So options chain, NFLX, and we're doing a diagonal put spread, okay? So the first thing we're doing is we're going to the very front month that covers earnings, which happens to be April 23rd, 3 days to go. And we're doing from the buy side the at the money put. So the stock yesterday closed around 550 bucks. So first thing, we're coming in here buying and at the money put. All right. So that's what I have queued up. Buying April 23rd put 550 strike and price $18.40. That's where the offer is. All right. Now we're going to do a diagonal put spread, meaning we're going to go to a different expiration, and I'm going to do a different strike. So I'm going to do an out of the money put, selling an out of the money put at a different expiration. Since we're referencing the 30 days, I'm going to go to an options that's close to 30 days out. So I think let's try May 28th. So May 28th has 28 business days to go. Okay. And we started at the 550 strike on April 23rd. So I need to find an out of the money. And in our back test, we usually reference 25 delta. So I'm going to reference these delta puts. Okay, these are the deltas. And I'm looking for the closest 25 deltas. So there's a 24 delta, 24 delta put right here. That's the 510. Okay, you could do 5, or you could do the 27 delta, which is the 515, but let's just do the 510. So we're selling the 510 put. Okay, so here are the two options that I've queued up. buying April 23rd, 550 put, that's at the money for $18.40, selling the May 28th expiration 510 put for $8.65. I'm going to load that strategy. So this is going to paint a picture, okay, of a payout diagram, but we have two different expirations. So one thing you have to consider is that at April 23rd expiration, this option will go away. But the May 28th expiration still goes to May 28th, right? So really, this strategy has to end at April 23rd. So what we have to do is estimate what do we think it's going to be worth on April 23rd, because after April 23rd, you don't have two legs anymore. You're only gonna, this one is going to go away. So you really need to take that off at April 23rd, or you have a different strategy completely, right? You're just going to have a naked put. So this graph is going to say April 23rd, this option expires. So whatever the parity is here, May 28th, this option doesn't expire. So we have to kind of estimate what this option will be worth at every different point. That means you have to give it some kind of implied volatility to estimate a value. All right. So that's how this is right now drawn. Payout diagram, April 23rd. Everybody get that? Hopefully.
I think everyone gets that. And Rob, who asked the question, says this is very helpful. Thanks, D.
Okay, awesome. So now that we're looking at it, here we see that if we do this strategy just like I set it up, buying it on the offer and then selling the bid, that'll be a cost of $9.75, right? You're paying $18.40, selling $18.65, that'll cost $9.75. But we see here, this is a wide market. So the bid is $6.45, the offer is $9.75. So we're just assuming you're getting immediate execution. The midpoint is $8.10. You want to always get an execution as close as you can to that midpoint, because that midpoint is considered kind of the fair market value at that moment. And if you're moving away from $8.10, it's kind of, that's your fee to get your execution. So if you're paying $9.75, that's $1.65 away from that midpoint fair value, mark to market fair value. So when you're doing that, pay attention to that, because to get an immediate execution, that's a high cost. So you could always put in a limit order. Now this graph is just assuming you paid to get an immediate execution. Anything below that, this graph would change. So if you paid $1.65, let's say you got it at $8.10. If you paid $8.10, well, that's $1.65 less. So this whole graph will shift in your favor by that much, $1.65. Okay, so your max gain would go up and your max loss will go down because you paid less. So that's how right now this is set up. So we see here that this strategy would theoretically, right, at expiration make money to the downside, assuming that the implied volatility is at 35.7 in the May expiration. We could change that because we think it's going to go down historically by as much as 30%, but maybe not, because we're already kind of low. We're in the 30th percentile rank. Implied volatility is subdued. But I'm going to let's take this down a little bit. All right. Let's take it down to 34. Let's just say it comes in a little bit. It might not, but let's just say it does come in a little bit. I'm going to rerun that strategy. And you could see that this lifted up a little bit because we're short Vega, right? We're short 39 Vega. In other words, this position for every for every implied volatility click, we take it down. For one volatility click down, we make $39 because we're short Vega. For one volatility going up, we lose $39. So I took it down to 34. this is what it kind of looks like. So if we're right here, where are we right now? Like around 500. Let me see where we're at. 503. So at the 503 level, this is what it would look like at expiration, April 23rd expiration, assuming this implied volatility. If I want to see, well, what is it maybe worth at the end of today? So I'm going to take this, compare payout diagram, April 21st. So this blue line is where we're at 503, assuming this implied volatility. So you got to make those assumptions, because remember, two different expirations, so they're not both going to parity at the same time. We're at 9:30. Well, hopefully, that was helpful. If there's any questions, we'll have to get to them tomorrow.
Yeah. So Rob, if you have any questions, you can email me, williammcbride@gmail.com. I'll get those over to Dimitri for tomorrow's show, or just let us know in the morning you have some questions, everybody. D, great job as always, my friend.
Yep. Great. Thanks, everyone. Thanks for joining. Stay safe out there. Have a good trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Have a great day.